I think the dollar is going to lose purchasing power at an accelerating rate in the foreseeable future. So that means you're going to need more and more dollars. You're going to need $5,000 to buy an ounce of gold. You're going to need $10,000 to buy an ounce of gold. The gold isn't changing. It's exactly the same. It's the dollar. So I think the sooner that you can convert your fake money into real money, the more of your purchasing power you're going to preserve. So yeah, people should absolutely buy gold at this level at 3,200.
Renowned analyst Peter Schiff has long been warning that the global financial order is undergoing a seismic shift, and the era of unquestioned US dollar dominance may be closing. With ballooning national debt, escalating interest payments, and a steady erosion of international trust in America's fiscal discipline, Schiff believes the dollar's privileged position as the world's reserve currency is no longer sustainable. He points to the de-dollarization efforts underway in major economies like China, Russia, and India as evidence that the world is preparing for a new monetary system where physical gold, not fiat promises, stands at the center as a neutral and trusted store of value. Central banks around the globe appear to be validating that view through their actions. According to data from the International Monetary Fund, IMF, the dollar's share of global foreign exchange reserves has steadily declined. Meanwhile, countries aligned with the BRICS bloc and others like Poland are aggressively increasing their gold reserves. Schiff interprets this as a signal that trust in the dollar's long-term viability is waning. He stresses that this trend isn't just a reaction to short-term volatility, but a deeper strategic shift away from politically weaponized currencies. With U.S. interest payments expected to surpass $1 trillion annually, and nearly half of America's new debt in 2024 tied to servicing existing obligations, Schiff warns that the sustainability of the current financial model is collapsing. Even with recent fluctuations in the gold market, Peter Schiff remains firmly convinced that gold's long-term trajectory is bullish and intact. While spot prices experienced a drop of nearly 10% from their April high of just above $3,500 per ounce to around $3,180, marking the metal's steepest weekly decline since last November, Schiff considers this a temporary pullback rather than a sign of reversal. He maintains that the core structural drivers behind gold's ascent have not changed. These include the historic pace of central bank accumulation, persistent geopolitical instability, and the steady erosion of confidence in fiat currencies, particularly the US dollar. Schiff emphasizes that growing investor demand in China and strategic efforts by many countries to shield themselves from dollar exposure will only reinforce gold's momentum. We present the clips from Peter Schiff's interview with Sachs Realty. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think we've just had one, right? Because we almost got to 3,500, and now we're barely above 3,200. So we had over a $300 drop. That's about a 10% decline, right, from the peak. That's a pretty good dip. So I think that if you were waiting for a dip, you got your dip. So at this point, there's nothing to wait for. So I think 3,200 is a very good price for gold. It's not going much lower than that. And, gold has been rising for many, many years. When this century started, January 1st, 2001, gold was under $300. So it's gone up 11x. Well, since then. It's gone up more than the stock market over that time period. Even if you count the dividends, the stock market hasn't kept pace with gold over that time span. But, if you go back to the beginning of the Federal Reserve, in 1913, you could buy an ounce of gold for $20. And so gold's gone from 20 to 3,200. Now, gold really hasn't gone anywhere. The ounce of gold you buy today is the same ounce of gold that somebody bought in 1913, right? It hasn't changed, right? It's not like, other things are different, right? The quality gets better, technology, right? So a lot of the stuff we buy today is different than stuff that was bought 100 years ago. But gold is exactly the same. Gold has not changed. And so it's not really that gold is a lot more expensive than it was, or 100 times more expensive than it was 100 years ago. The dollar is 99% less valuable than it was 100 years ago. So you need 100 times the number of dollars today to buy the ounce of gold that you could buy for $1, right? Because of how much purchasing power the dollar has lost. And I think the dollar is going to lose purchasing power at an accelerating rate in the foreseeable future. So that means you're going to need more and more dollars. You're going to need $5,000 to buy an ounce of gold. You're going to need $10,000 to buy an ounce of gold. The gold isn't changing. It's exactly the same. It's the dollar. So I think the sooner that you can convert your fake money into real money, the more of your purchasing power you're going to preserve. So yeah, people should absolutely buy gold at this level at 3,200. My company is Schiff Gold. Don't wait. As soon as you listen to this, if you don't have any gold, or even if you do, you want to go to Schiff Gold and buy some. And we don't sell, numismatics or collectibles. We're going to get you a great price on bullion. But if you want to get a really good bargain, buy silver too, because silver is only about $32 an ounce. You can get 100 ounces of silver with 1 ounce of gold. I mean, silver has never been this cheap in the history of silver. So I think silver has got a lot of upside to catch up. So if you think, hey, I was looking at gold when it was 2,000 and shit, I should have bought it. Now it's 3,000. Well, silver is the same price now as it was when gold was at 2,000. So just buy some silver. We sell Schiff Gold. We sell silver at Schiff Gold too, even though it's not part of the name. And we've been selling more silver recently. I've been really, telling people to buy silver. So, but you should buy both. But I think you should definitely buy silver too. Don't just buy gold, because I think, you'll do better in silver right now. It's hard to believe too that people have actually done better just buying gold than buying the S&P 500. And gold doesn't do anything. Gold just sits there. Yet all these income generating companies, even with the income, haven't managed to beat just a precious metal, just sitting there doing nothing. So it really shows you what's been going on in the economy. The stock market has gone up in price, but so has everything. And the reason that everything goes up in price is because they create so much inflation. They destroy the value of our money. And that's what gold is telling you. The dollars we have today are not worth the dollars we had yesterday or 10 years ago or 20 years ago. And I think more significantly, the dollars that you're going to have in the future, if you're foolish enough to hold on to them, are going to be worth substantially less than they are now. So you're going to need a lot more dollars to buy an ounce of gold. And you're going to need a lot more dollars to buy an ounce of anything, because the dollar is going to lose the vast majority of its purchasing power.
The government's relentless borrowing has created a culture of unsustainable debt that inevitably trickles down to American consumers, making the nation's financial obligations impossible to sustain indefinitely. Other countries are increasingly aware of this reality and are actively adjusting their strategies in response. The era of unipolar dollar dominance was always destined to end. Still, the conclusion promises to be a dramatic upheaval that could fundamentally alter the comfortable lifestyle Americans have long enjoyed. Past crises like the 2008 financial crash or the Great Depression pale compared to the potential fallout from the dollar's decline, and delaying the inevitable only intensifies the severity of the eventual collapse. According to the Gold Advocate, the Federal Reserve never stress-tested banks against stagflation, a rare scenario where economic weakness coincides with rising inflation and interest rates, highlighting the fragility of the current financial system. The International Monetary Fund reports that gold now constitutes a significantly larger portion of global reserves than a decade ago, reflecting growing international trust in gold over U.S. Treasuries as the ultimate safe haven. As the world shifts toward a multipolar currency system, the weakening dollar could provoke turmoil across equities, bonds, and real estate markets, deeply tied to the currency's stability. Gold excels amid such uncertainty, having outpaced inflation and most other asset classes this year. Yet its true strength lies not in short-term price movements, but in preserving wealth when fiat currencies collapse under inflationary pressures and flawed central banking policies. As demand for the dollar wanes, the value of U.S. assets, especially foreign-held treasuries, will likely decline.
The Federal Reserve really has been the principal architect in the house of cards economy that we're living in, and that is, I think, very close to collapsing. Um, and the problem is not that they're not cutting rates. The problem is that they've cut rates too often in the past, and they've left them too low for too long, and they've printed too much money. Donald Trump does a good job of pointing out some of the consequences of bad monetary and fiscal policy, like our huge trade deficit. But his prescription is completely wrong, right? He says, well, what we need is tariffs and rate cuts. And we actually need the opposite of that. We don't need any tariffs. We need free trade, but we need rate hikes. The reason that our trade deficits are so big is because our interest rates have been so low, and they've encouraged excess consumption. And we haven't been able to produce enough to satisfy that demand. And so we've relied on the rest of the world that is far more productive to produce the stuff that we don't, so that we have something to buy with all the money and credit that the Fed creates. And so we have this huge imbalanced economy, but the source of the imbalances is the United States. It's our monetary and fiscal policy that is the cause. It's got nothing to do with China or anybody else. It's got nothing to do with cheating. Um, it's just our own policy mistakes. And trying to blame the rest of the world for problems that we create just deflects attention from the actual cause and assures us that the problems get worse. They don't get solved. And I think, though, what we're close to, and this is the most significant development, is I think the world is going to be revolting against this system that has disproportionately benefited the United States at the expense of the rest of the world. And that is the dollar's reserve currency status. And that is the enabler of these imbalances. That's what allows Americans to live beyond their means. That's the reason we've been able to get away with these massive deficits for so long, with all the excess consumption and the under savings and this, service sector, consumer driven economy. It's all a byproduct of the dollar's reserve status. Without that, the whole house of cards would have collapsed a long time ago. But I think, we've already started that process. I think the de-dollarization process has begun. When it concludes, America's ride on the global gravy train is going to be over. And, Donald Trump mischaracterizes this. He says, hey, the world has been screwing us over. The world's been taking advantage of us and ripping us off. It's actually the opposite. And I think the world is now mad as hell, and they're not going to take it anymore. And they're not going to take our dollars. And so we're going to be stuck with them. What we have been getting is all their stuff, right? All the goods that the Chinese and everybody else produces. We've been getting all that stuff without having to make it. And all we've been doing is giving them our paper, which we print for nothing. But I think this is going to end, and it's going to be a big collapse in the American standard of living, because we're not going to have a lot of stuff to buy. We're just going to have a lot of money to spend. And so prices are going to go through the roof. Interest rates are going to go through the roof, because nobody's going to have access anymore to the foreign savings. That's why our rates are low. It's because we're able to tap into the Chinese savings. But when the world no longer wants to make its goods or its savings available to Americans, then we're on our own. We can only consume what we produce, and we can only borrow what we save, which is not enough. So we have a huge increase in consumer prices, a huge increase in interest rates, and an economy that is built on a foundation of low prices and low interest rates implodes. And you have massive bankruptcies, foreclosures, lots of unemployment. It's going to be far worse than the 2008 financial crisis. And there's going to be no bailouts. 2008 crisis would have been much worse had there not been any government bailouts, which would have been better, because maybe we wouldn't be in this mess today had we swallowed the medicine back then. But this time it's going to be a much worse crisis, and bailouts are impossible, because the way the government bailed everybody out in 2008 was by printing money and by issuing more treasuries. But this time it's going to be the dollar and the treasury market that is at the epicenter of the crisis. And so more dollars and more treasuries will just make the crisis worse. So if the government tries to bail anybody out, the crisis that they're trying to, cushion is going to get worse. So their stimulus is going to be a toxic, going to be a sedative.
De-dollarization is reshaping the global financial landscape at an accelerating pace as countries seek to reduce their dependency on the US dollar amid mounting economic uncertainties and geopolitical friction. This shift drives nations to diversify their reserves by increasing allocations to more stable and universally trusted assets, with gold emerging as the foremost beneficiary. While gold has experienced short-term price volatility, its overall trajectory remains robust. Leading financial institutions like Goldman Sachs' research project that gold prices could climb to $3,700 per troy ounce by the end of 2025, underpinned by sustained central bank acquisitions and expanding interest from exchange-traded fund (ETF) investors. Additionally, expectations of forthcoming interest rate reductions and fears of an impending global recession are anticipated to further accelerate gold's upward momentum, with forecasts suggesting prices may reach $3,880 per troy ounce. That's it for today. Share your thoughts on Peter's prediction on gold and silver prices in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.